Good morning, students. Today I am going to discuss consumer loans. The term consumer finance means the activities which are involved in granting credit to consumers to enable them to possess goods which are meant for everyday use. So, business procedure through which the consumers purchase semi-durable and durable goods other than the real estate in order to obtain a series of payment which extends over a period from 3 months to 5 years. Now, what are the types of consumer credit? First is revolving credit. The best example for revolving credit is credit card, which is an ongoing credit arrangement whereby the financer or whereby the finance is given on a revolving basis. So, consumer is entitled to avail credit to the extent sanctioned as per the credit limit. Fixed credit. It is like a term loan whereby the financier provides loan for a fixed period of time and it has to be repaid within a stipulated period. For example, monthly installment loan or hire purchase. Cash loan. Under this type of credit, bank or the financial institution provide the money to the borrower with which the consumer can buy the goods for the personal consumption. So in this case, the lender of the money and the seller of the good, both are different, and the lender does not have any responsibility of the seller. Secured finance. When the credit granted by the financial institution is secured by a collateral, is secured by a security, then it is in the form of secured finance. So collateral is taken by the credit in order to satisfy the debt in case of any default committed by the borrower. So this collateral security can be in the form of any personal property or liquid asset, etc. Unsecured finance. When no security is offered by the consumer against the loan, then it is called unsecured finance. Now, what are the sources of consumer finance? First is traders. The predominant agencies that are involved in consumer finance are traders. They include sales finance companies, hire purchase, and other financial institutions. Commercial banks. Commercial banks also provide finance for buying consumer durable items. Banks lend large sum of money at wholesale rate to commercial or sales finance companies or hire purchase companies and other such finance companies, and banks also provide direct loans to the consumers for purchasing consumer durable goods. Credit card institutions. These institutions arrange for the credit purchase of consumer goods through respective banks which issue the credit cards. It enables a person to buy the credit card services on the credit. So on the presentation of credit card by the buyer, the seller prepares 3 copies of the sales voucher, one for the seller, one for the bank or the credit card company, and third for the buyer. Then the seller forward a copy to the bank for collection, and the seller's bank forward the bill to the credit issuing company. The bank debits the amount to the customer account. So bank receives monthly statement from the credit issuing bank or the company, and this amount is to be paid within a period of 20 to 45 days. NBFCs, that is non-banking financial companies. They are also an important source of consumer finance. So consumer finance companies are also known as small loan companies or personal finance companies or non-saving institutions whose primary task is to provide sales finance. So personal cash loans, short-term or medium receivables, and they charge substantially higher rate of interest than the market rate. Credit union. Credit union is an association of people who agree to save their money together, and then they provide this money in terms of loan to each other at relatively lower rate of interest. They are just like cooperative credit societies. Next, what are the modes of consumer finance? First, open account. So any number of purchases per month up to a certain value. Credit card, it is the most popular mode of finance. Revolving account, in this the purchases during a month and payment on the installment basis. Option plan, that is option of paying in full or part. Installment account, the payment is made in the form of EMI, equated periodic installments. Cash loan, the purchases are made through cash and payment is made periodically. Now, why there is increasing demand, or what are the factors which are responsible for increase in consumer finance? First, there is increase in consumer disposable income. Second, there is enhancement in the real income of the consumer. Third, convenient size of installments which can be repaid by them out of their small income. Growth in nuclear families leading to number of households, so there is more demand for consumer durable goods. Low charges, charges are not too high, and down payment and credit contract. A small amount of down payment is required. Now, which products are covered? Consumer financing covers a wide range of products like cars, television, washing machines, refrigerators, air conditioners, computers. So the products covered possesses some distinct features like they are durable products, sustainability, saleability and serviceability. Now, what are the terms of finance? First, before providing loan, the lender checks the eligibility of the borrower. The basic eligibility for consumer finance is the income of the individual customer and the nature of his employment. So EMIs are worked out on the basis of number of installments and what are the tenure of employment of the customer. Guarantee. Banks also insist, or financiers also insist, that there should be guarantee for the loan. So guarantee is obtained in order to ensure prompt payment of installments. Tenure. Consumer finance is generally granted from a short period of 3 months to 5 years, but the tenure also depends upon the value of the asset purchased. Assets of smaller value are given on short-term credit and assets of higher value are given on long-term credit. Rate of interest. The effective rate of consumer finance is much higher than the rates applicable to business finance. So this is because the loans depend upon the credit rating of or the personal integrity of the customer. So the effective rate of interest varies somewhere between 20 to 30%. Other charges. In addition to rate of interest, the companies also charge documentation fees, processing fees, collection cost, service charges, etc. So a deposit is also taken as a precautionary measure to guide against the default. Mode of payment. Mode of payment in this case, post-dated checks are usually taken from the borrower at the time of granting the loan. In case of institutional financing, there is an arrangement of deduction of installment from the salary of the employee directly. Credit evaluation. A verification of details furnished by the customer is carried out in order to ascertain the validity of the statement and credit standing of the customer. So what conditions are taken into account? The age of the borrower, monthly income, status of his employment, previous record, assets owned by him, and the types of collaterals offered. Now, what is the mechanism to price the consumer finance? The pricing of consumer credit depends upon the extent of facility offered by the financier. So basically it is interest-free rate of interest plus default risk premium plus administrative expenses. Now, what are the advantages of consumer credit or consumer finance? First, enjoying possession. So important benefit of consumer credit is it allows a person to enjoy the possession of goods without paying for them full immediately. Saving. Consumer credit allows for a mechanism of compulsory saving because it induces a person to save for the EMIs out of their monthly income. So it promotes saving. Third, convenient mode. Consumer credit offers a convenient mode of buying the consumer durables. Meeting emergency. Consumer credit is also very much essential in meeting the emergencies conditions like illness, accident, death, which involve unexpected expenses. Maximization of revenue. Consumer credit facilities helps in speedy disposal of goods which would have remained unsold if consumer credit is not given to the consumers. So this help in increasing the sales as well as the profit through credit sales. It accelerates the industrial investment. Consumer credit accelerates the investment in consumer durable industry, which give rise to growing level of income and employment. it an enhanced living standard. Consumer credit enables the people of limited means to get the goods and they can raise their standard of living. Promoting economic development. Consumer credit promotes higher level of investment, employment and income. Thus it raises the demand and promotes a higher standard of growth and development. Now what are the disadvantages? First, thoughtless buying. Because of these attractive consumer credit services, some people buy the goods indiscriminately even if they are not required by them. Second, insolvency. Credit forces people to mortgage a substantial portion of their fixed future income. A main portion of their income is used to pay the EMIs, which may sometimes leads to insolvency and bad debts. Costly credit. Consumer credit, with its benefit of convenience, buying brings with it severe consequences because it is costly credit, as effective rate of interest is much higher than on the paper. Risk to traders. Consumer credit poses considerable risk to traders because if the buyer defaults on the payment, the lender can acquire the good but cannot sell it on the original price. So sometimes the seller bears the risk. Artificial boom. The consumer credit facilities create artificial boom in the consumer durable industry. Bad debts. Consumer credit generates a substantial amount of revenue for traders, but simultaneously there is a high risk of bad debt. Economic instability. Indiscriminate consumer credit leads to economic instability because of recurrence of booms and slumps. So in boom there is credit extension, but in recession there is credit tightening. Thank you.